So welcome back to the channel, everybody. I have a special guest today, Adam Patty from Vistashares, if I make sure I say that correctly. And we're going to talk about Omaha. At least I'm going to call it Omaha because they left off the A, but hey, we're going to call it Omaha because it sounds really good. And Adam, go ahead and introduce yourself.
Well, first of all, thanks so much for having me today. It's a pleasure, and I'm just we're really excited about what we're doing over at Vistashares. I've been in the ETF market for, believe it or not, since '01. I launched an ETF, or we launched an ETF back when I was running Fortune Indexes at Time Warner with State Street, the Fortune 500 ETF, and really early in the days of the ETF world. And then I started a company in '06 called Index IQ. We specialize in liquid alternatives, where we would create institutional class alternative strategies and embed them in the ETF structure. Built that up, sold that to New York Life in 2015. Was at New York Life for 3 years, rolling out ETFs for them globally across their platform, and had the good fortune to get back into the industry I love. And here I am, a year in on Vistashares. Just recently launching our first products, and really excited about what the future holds.
That's right. And you have two products. We're going to talk about Omaha being the main product because I'm in the income space. But what's your other product?
So the other product is ticker AIS. That's artificial intelligence super cycle. So my partner in this business is a guy named John McNeil. John was the president of Tesla. He was the chief operating officer at Lyft. He's on the board of General Motors. He's vice chairman of their autonomous vehicle division. He's a technical just guru and an incredible businessman. So he was looking for a way to invest in AI and couldn't find an ETF that actually provided real AI exposure. So he came up with this bill of materials process. We dig into the supply chain of these kind of disruptive technologies to really build out a portfolio that captures the infrastructure, kind of the picks and shovels, the companies that go into building the high performance AI data centers and the high performance AI semiconductors. And so it's kind of it's a very different approach to getting exposure to AI. And it's the only product like it on the market. And that was our first product we launched in December. And, it's been doing really well. Really, it's been really volatile in the AI space over the last month or two. But
it has not done well, right? In some aspects, right? But yeah. I'm a firm believer of AI. I think that's going to be something people should have some exposure to, right? It depends on how you get that exposure, but there you have a way of getting exposure, but it doesn't have income. And I am a income investor, right? So at least this side of my portfolio, we're going to talk about Berkshire Hathaway because I do have Berkshire Hathaway in my growth side, and I didn't sell it. And we'll show you a chart why I didn't sell it, but I did sell my other two. But Omaha, describe that to us of how that's actually based on Berkshire.
Yeah, this is a really exciting product. I mean, I've been in this business for a long time, and I don't think I've ever had a product that has just been embraced by the investor community so quickly. So very simple. This is invest like Warren Buffett, but with 15% annual yield target paid monthly. So we create a portfolio comprised of 21 equity securities. Their top holding is BRK.B. Our next 20 holdings are Berkshire Hathaway's top 20 holdings, Apple and American Express and Bank of America and Visa and all those amazing companies that are his top conviction picks based on how much allocation he has in his own portfolio. So it's those 21 securities. Then we have an active options overlay strategy that is designed to provide 1.25% distribution per month for 15% per year.
Hey, real quick on your weighting. How are they weighted, and when do you reconstitution, and when do you rebalance on weightings?
Great question. So we rebalance quarterly. So we're looking at their updated Berkshire Hathaway holdings every quarter. And then, the final one of the year is the recon. But, he doesn't switch his holdings very often. We're really...
No, he doesn't. No, he doesn't. But and the reason I asked is I looked at your holdings, I looked at his holdings and said, yeah, they got a little bit out of balance already. But then again, you can't expect a stock to be stagnant. right? So it's
Correct.
good that you're doing it on a quarterly basis for
Yeah, rebalance back to where he holds them. I mean, it's a pretty simple process, and
sure,
yeah.
sure. And you do an income overlay. Why 15%?
You know what? We were looking at a variety of things. First, obviously we're looking at the competitive landscape and, where investors were, looking to invest, right? So there's a lot of products out there that are providing that 8 to 10 to 12% range. Then there's a lot of products that are providing kind of the nosebleed range. And we don't, my background is really institutional class investment strategy. So the nosebleed range is, not for me. It's a great strategy for those people who like it. But for me, it's not really what I do. So we were looking for a place where we can play that had a unique, value proposition, but wouldn't experience the NAV erosion. So
And that's what everybody's afraid of is NAV erosion. And when I first looked at it and said, is there the volatility in Berkshire Hathaway to get 15%? Because options are based off of volatility. And let's say the volatility goes down on some of the Berkshire Hathaway options. Is there a is there a secondary plan for you to in that?
well, I mean, again, we're writing options not on just on BRK.B, but we're writing them on the 20 underlying holdings
Yeah,
as well.
and stocks always have more volatility than a index,
And it
right?
changes day to day, right? So yeah, I mean, there could be times when there's lower volatility. Clearly, now is not one of those times. So we're banking a lot of income right now because of all the drawdowns and run ups. But yeah, so if there was ever a scenario where all of a sudden all 21 holdings had no movement and we couldn't somehow get to the 125, we could use index options as a proxy as well. That's a backup plan. That's not our
Yeah,
stated.
that's right. Yeah, that's right. So you have more than just one plan. You've
Correct.
you've allowed for other plans to occur than being stuck with just one scenario. I mean, you could say sink or swim. This is what we're going to do, and yeah, let's face it, some ETFs are that way, right? That sink or swim. We're going to sell on Amazon and only Amazon, right? That's a sink or swim scenario where you have a broad base.
Correct. And that's, again, looking at it from an institutional perspective, that it's important. You need to have your plan. Then you need to have a backup plan. You need a backup to your backup plan. And so that is how we built this product because, we don't want to sink, right? We have to swim. So, or disappoint investors. And once you disappoint investors, it's tough to get them back trusting you. And we got to build trust in the market. So it's not only on where we write the options, but all the different strategies we could use to generate that income. We have, several different strategies that we can back up to.
That's right. Because I, looking at it just last night, it looked like you had some call spreads. It looked like you had some calls. And I was happy to see that you had some laddered calls, right? Where, you had different strikes on the same stock, which really helps you out just in case you touch one or go through it. You're not fully capped, right? You still get partial growth, which is always interesting.
I mean,
How
the
often?
call spread thing, to your point, is unique as far as I understand in terms of the ETF space. And, we want to make sure, and particularly in today's markets, right? I mean, you want to be able to get some of that upside. So the call spread feature, I think, is unique to Omaha and our other income products that we'll be bringing out.
That's right. And when you go and one thing that we've talked about, if you go through that call spread, anything over that 1.25 accounting wise, you're keeping.
Correct.
Right?
We're not looking to, pay 3%. We're not looking to blow out. We're here to provide consistent income for the investors, and we're going to bank the extra profits and put it back into the NAV,
That's
um,
right.
which helps the upside, obviously.
Yeah, and we get into taxes like that, but eventually you could actually take that and say, hey, we don't need as much income. We can write the calls farther out, right? That's a great conversation of, hey, you can get more upside potential to back things in. So it's great to have options and somebody understanding the income investor of, hey, we don't want our NAV to drop, on a consistent basis. We want, an active manager like yourself.
Yeah, and to the NAV erosion is such a an issue for investors, and I get it. So that was something we really took into great pains to design around. So, our first distribution was last week, and we paid out 0.25025 on a $20 2002 NAV price or something in that range. I don't want to misspeak, but yeah. So there was no NAV erosion. It was the quarter that came out as which is what you expect.
That's right. And that distribution, that distribution, how much was it was ROC, and let's talk about taxes on that.
Yeah, it was just under 96%. I think it was 95.83 or something in that range. Our 19A is on our website now, but I'll call it 96%, just to use round numbers. So yeah, and that's our goal. I mean, we are, ROC is a critical component for investors, and we understand that clearly, and that's what
Sure.
we're going for.
Yeah, and some of these will be qualified dividends, because I'm assuming you'll pass through like the Coca-Cola dividends,
What's
right?
interesting, yeah. I mean, what's interesting is, I was talking to the team the other day is, we are looking ideally to bank those dividends. The actual dividends that are coming through from the underlying securities are being banked and put back in the NAV. So
Okay, interesting.
the 15% is what we're actually generating from the option strategy, and we're banking the dividends.
So you're going to take the Berkshire methodology, right? Because Berkshire doesn't pay any dividends out because one thinks that he can do better than the regular investor, right? So he's going to hold them, and that's interesting that you'll keep that for your NAV, which is by the way, which, hey, if I'm making 15%, I am totally fine with you doing so, right? So especially if you can look at it from a tax perspective, right? Because the better taxes for all of us, right? For yourself, for us, that's an accounting. And trust me, I'm not an accountant, but we'll just, from an accounting point of view, whatever you can do for the investors, probably good for all of us.
Absolutely.
So how long has the fund actually been out since you've done your first distribution?
Yeah, we launched on March 5th.
March 5th.
Yeah, the underlying index goes way back beyond that, not with the options overlay, but just the equities.
Yeah.
Yeah.
One's been around for a couple of years.
Yeah, he's a pretty good bet, I think, on his stock picks. But yeah, it's a little over a month, and our first distribution was the key, so we kind of just sat tight, waiting to see the first distribution came out, and we were thrilled, of course, that we did exactly what we said we're going to do, which we will be doing every month. And it's a critical piece. And particularly in the volatile markets, it's been pretty, I don't want to say easy, but the volatility is so severe that banking those dividends or banking the income is, we're banking a lot of it in like one day and then moving on. So it's been great.
Yeah, collect what you need, and and that is, we don't always expect the volatility to be there, but it has been extremely high for the last, I guess about a week or so since the tariffs have been announced. And have you looked at tariffs on your holdings and how that they would affect? Or?
Yeah. I mean, look, we have, and because we want to be intelligent to be able to articulate to investors that they have those questions. But I mean, look, we got clobbered with Apple. Obviously, Apple is our top holding after Berkshire.B because that's his top holding, and that got clobbered. Yesterday was a great day for Apple, of course, and I'm guessing today it's down again, given what the market was doing before we got on. But we've got a lot of financial exposure, which in theory I would think would have a little bit of a little more of a protective mode against the tariffs. But a lot of the financials got clobbered as well over the last week. So there's a lot of drawdowns across the market in the blue chip area.
Yeah, and I see that you hold Coca-Cola, which is something I've always, liked, just from being my age, right? Bank of America, Visa, right? Moody's, Kraft, Heinz, right? So, and you got both Visa and MasterCard, just like Warren does. So those make sense. Can you tell me anything else about the fund that you really want to express of how you think that this will play out over the years?
Yeah, I mean, what I loved about this fund the most is like whenever I've launched a fund in the past, it's, look, the dirty little secret in the ETF market, being that I've been in it so long, is it's very marketing driven, right? Which is, I guess, consistent across a lot of different areas of, of financial services. But I never wanted to be one of those guys that launches a fund just to launch a fund. That doesn't necessarily provide what your investors are looking for, or doesn't have a clear use case. So when you look at this fund, it's to me, there's two clear use cases. One, it's a core equity holding, right? So if you're looking for core equity with some income, it's a great way to complement your your SPY and your Qs and things like that. But the other clear use case, which I thought was very interesting, which actually I thought about after the fact, was if you own BRK.B or A, mostly B, of course, as you mentioned, Berkshire Hathaway does not pay a dividend. So if you want to create a synthetic dividend for your BRK holdings, you carve off a little of your BRK.B, you add a little Omaha, OMAH, and you've got the same or similar exposure on the equity side, but then you have that synthetic dividend coming in from OMAH. That is a nice feature, which a lot of investors seem to be resonating or gravitating to.
That's right. We like that income to come in, especially in retirement, right? I mean, and personally, I try to tell everybody, I take 8% and I reinvest the rest. Right? I think, call it. I'm taking. If I did invest, I'd take just over 50% and put the rest back in, because I think in retirement that is a whole lot better than the 4% rule.
Yeah, I love that. I love that. And it's funny. I've been on X a lot, and just getting into this whole dividend or income space. It's amazing the level of sophistication. Not amazing is not the right word. I guess I was a little surprised about the level of sophistication of the retail investor today versus where they were 10 years ago when I launched Index IQ, or 2006. It's more than 10 years ago. It was a while ago. But, the retail investor today is so much more in tune with their portfolio and investing strategies and how to drive that income and how much to reinvest and where to deploy it. I mean, I'm taking notes from them. I mean, I consider myself kind of a portfolio construction guy, and that's been my background. But these guys and girls are super in tune with what they're doing.
And let's face it, you're probably similar age of I am. When I first bought my first stock, we used the thing with the little dial on it and called, right? And paid $25 for that transaction.
Yep.
Right. And the amount of information the internet has given us today, that we can drive a lot more than what we had before. And there is the whole boomer thing. We're coming up our retirements, and people are looking at how do you generate income in retirement on a reliability sector, right? So,
a critical piece. I love seeing it. I just love seeing people take responsibility with knowledge for their financial outcome in the future, and it's really great to see. So it's been a lot of fun for me to be on X and kind of playing around and talking to people and meeting smart people. It's great.
Yeah, let's bring up a couple charts. I'm going to really throw you in front of the bus. Let's look at a couple charts here real quick. All right. So when we first came out, I took when you first started, you have Omaha, and you're beating SPY, and you're beating SPY in total returns, which is impressive.
Yeah, I mean, it's great to see. I don't like to push performance, obviously, because performance changes all the time. But this is kind of expected. I think this is what we would expect, or I would hope for over time. Warren Buffett is the best stock picker in the world, in the history of the world. So hopefully his holdings, which are all kind of blue chip holdings, they're not, he's not buying micro caps, obviously. So you're getting a similar kind of volatility dynamic to the SPY, but hopefully you're going to see some outperformance over time.
That's right. And then when we look at Berkshire on total returns compared to yours, hey, Apple did not do you any good here recently.
Neither did Bank of America or Citigroup. Yeah, I mean, yesterday when the market went straight up, we outperformed BRK.B by 1.75% or something like that. So we made up some ground yesterday. But the reason for this is, to me, and I haven't done the full attribution, so I don't want to misspeak. But we have the top 20 holdings of BRK.B. Of course, Warren has a lot more holdings underneath that. So his tail was outperforming his top 20 over the kind of a lot of the volatile periods over the last couple of week or two, particularly in the last week. So yesterday, a lot of those blue chips, the Citigroups, the Bank of Americas, the Apples, they roared back to life. So we outperformed. So I think that all kind of evens out over time. I wouldn't expect. I think on the upside capture, I think we're kind of shooting for the 70 to 75% range over time. We're not going to get 100% of BRK. That is not what we're doing. I want to make that clear. But we will 70 to 75%. I think is a good expectation. At least that's what I'd be expecting. And then on the downside, 90%. We'll get a little bit of downside protection, not because it's innate. We're not providing a buffer. We're not doing that. It's not part of our strategy, but just because of the options overlay and how we're managing that, we should see some downside protection over time. So that's kind of where we're looking.
Good. That's let's talk about what the future is for you guys. You got a couple more coming out, and I really like this. I like I looked at the value one right off the top. You had price to book, you had cash flow to price, earnings to price, EBITDA, and sales to enterprise on picking your holdings, which is what value investors look at, right?
Absolutely. So, the goal here is to provide that equity tilt that investors are looking for. So one of the most important strategies for sophisticated institutions and sophisticated investors is to use factor-based products to give you that equity tilt. Now, over the past couple of years, momentum was the one that people were tilting to because you're getting a little more of that upside pop. But so these are these kind of are modeled after the traditional factor-based ETFs or factor-based strategies that investors are using, where we're using the traditional factor models. So you mentioned value, for instance. We're creating a tradition. I keep saying traditional, but I keep saying that because we're not trying to do anything fancy here. What we're trying to do is provide you that value tilt. So if you put it, I'm going to get a little geeky now, but if you put it through a Fama French 4-factor model, you're going to see that tilt. Value tilt or the quality tilt to the equity. So these are portfolios of anywhere from 25 to 50 securities. We're rebalancing them quarterly using our model, and then we're overlaying, just like Omaha, we're overlaying our 15% annual target yield per year paid monthly. So it gives you investors that core exposure on the equity side. Very different portfolios, most likely than Warren's, than Omaha. But with that tilt and the income. So a very unique approach. And investors seem to be clamoring for it. So we're going to hopefully get one or two of them out soon.
Yeah, each one was interesting when I looked at how you were going to pick your stocks and how to balance those out, because not each one would have, you may have one to have a couple of them overlap, but there's not going to be a whole lot of overlap in all of them.
No.
So
now they're all very distinct. That's why I focused on those four. For the next launch, I mean, I'm kind of liking the quality product, and that seems to be, But again, to your point, value is it's a good time for value investing, and a low vol product would be pretty cool right now. I think.
Right now that would have been very interesting for investors, right?
Yeah.
But then again, having diversification across the board really helps investors just get away from, let's say, SPY or the Qs, because a lot of these funds are based on indexes, right? And here, Omaha is based on Warren Buffett's picks, which you can consider to be an index, right? So
Absolutely. So, yeah, we're really proud of this product. We think it's going to do very well. And again, it just comes back to quality, not quality factor, but quality of the investment strategy. So we think we're providing something of quality that has clear use cases. And, we have high hopes for it. We think it's going to do very well.
So far, it looks good to me.
Yeah, I mean, the asset
right?
growth has been really strong. Again, we haven't really been out there marketing it until just this week after the first distribution. So, we had 4 more creation units yesterday, or day before yesterday. So yeah, we'll be up around. It's still a baby. It's a baby fund still.
Hmm.
We'll be up around 12, 13 million either tomorrow or Monday when those creates clear. But we started the fund with 1 million in seed capital, so we burned through that fast, and we've got leaped up to 13 million pretty fast. I mean, for me, that's fast in terms of my experience. And now we're out there talking about it, so we anticipate to really scale it quickly.
That's right. And a lot of people won't touch funds until you get to 90 days.
Mhm.
All right. And then you get out, the other funds go out to, about 6 months, because 90 days starts the due diligence process.
Yep. Yep.
All right. So it looks like a long term prospect for the income investor, which is, it looks like a win for us,
I agree.
right? As well as yourself, right? And it's good to meet the faces behind the funds that are out there, because you're just a human being like the rest of us.
That is for sure. That is for sure. Just trying to do the best job we can, and you know, make sure our investors are pleased with what we're doing, and never overpromise and underdeliver. That's kind of the main goal I as a person. So that's what we try to do here.
Sure. Sure. Hey, well, I appreciate your time, and anytime you want to come onto the channel, we'll have you on.
Oh, well, I appreciate it. And this was a lot of fun. And, if there's any follow-up questions from you or any of your viewers, I'm happy to answer them, and I'm looking forward to it.
Anything else you want to talk about?
No, I think, just, we put out quite a bit of research on our website. Actually just launched a piece of content around Omaha yesterday. That's up on our website, vistashares.com. We do every other week, we do something on on the AI space for the people interested in the AI space. So yeah, I mean, we're on X under VistaShares ETFs, and LinkedIn at VistaShares. But we're just, so take a look and always reach out with any questions.
How often do you put out the newsletter?
The AI one goes up every 2 weeks. So that is really, it's not a product. We don't product. We'll try not to product push. So the AI newsletter is every other week. It's really a investor digest to see what's going on in the AI space.
Sure.
Where people are making investments and where the money's flowing from a capex perspective. What's the important news? And the Omaha one, we just put up our first one yesterday. We're going to try to do that every other week as well. But we're gearing up for that. So this was more of just a high level overview of the product and the strategy. Next time, we're going to come out with something a little more deep dive on the options overlay and how that's run. We'll do something after that on tax consequences and ROC and things like that. So, we're just going to try to float this educational content out that hopefully is not just applicable to what we're doing, but if any subscribers are interested in income space, hopefully it's universal knowledge that will.
Sure. Well, I signed up for your newsletter yesterday, so
Awesome.
yeah. And I really push reading newsletters. I probably get, I don't know, 3 or 4 a week, right? To actually read them. That way we all stay educated of what's going on in the marketplace.
Critical, particularly in today's market. You got to be extra diligent and extra cautious. Just be smart and stick with your plan, and just be don't wildly sell out. That's what, right? Just be careful.
Especially for your income, right? I think I told you I did not sell my income side of my portfolio.
Yeah,
I need the income to live off of.
Yep.
Right. I did try to do a little gameplay with my growth side, but growth for me is growth, and income for me is income.
Yep. Two distinct animals. I agree, 100%.
Right? And then I did not sell my Berkshire Hathaway, so I am a Berkshire Hathaway believer.
Yeah, you are a star. That was the best move. Warren is kicking butt.
That's right. Awesome.
Thank you very much for having me. I appreciate it.
You're welcome.